morning, everybody. Thanks, Tim, and congratulations on your first budget breakfast seminar. We may be doing one together in July, depending on the vote. So, yeah, as Tim said, I'm going to talk about the personal tax side. There was a lot in the budget on the corporate and the property side. I think the sugar tax and the Tory infighting over the past week has really stolen the headlines. But when you dig through the 150 pages of the budget document, there is a fair old bit to look at on the personal tax side as well. So, income tax planning. Probably good to re-familiarise ourselves with the system in the UK at present. It's quite a quirky system in that there are a few anomalies for higher rate taxpayers to do with child benefits, people earning over £100,000 a year, and there is some planning around that can help clients try and avoid some rather punitive rates of tax. So if we start on the left-hand side, now you don't pay any income tax until you earn over £11,000 a year in the UK. You then pay basic rate tax at 20% up to £43,000 a year, and then you're then into 40% or higher rate tax. But there is an anomaly for people with children who are claiming child benefit. Now, if you're earning over £50,000 a year, the child benefit actually starts to taper away until somebody earning 60,000, so someone in the household earning over 60,000 a year, the child benefit actually disappears completely. And obviously child benefit's tax-free, so it's a very valuable benefit for a lot of families out there. We've also got the strange anomaly where once you hit earnings of £100,000 a year, for every £2 of earnings above that figure, the personal income tax allowance starts to disappear. So eventually, by the time someone's earning £122,000 a year, there's actually no personal income tax allowance whatsoever. And the effective tax rate on that portion of income is actually 60%. There are ways to get around that, things like salary sacrifice potentially, or paying money into a pension, various other things we can look at with clients. But that's a system we have to deal with in the UK. At the far right-hand side, you've got high earners earning over £150,000 a year who pay 45% tax. That used to be 50%, but that was dropped down to 45% 4 years back. So quite an odd UK income tax system. It was announced in the budget that the personal income tax allowance is going to go up to £11,000 from the 6th of April. I think George Osborne's aspiration is to actually increase the rate of earnings to 50k before you actually start paying higher rate tax. So that's a big uplift compared to where we are today. Obviously, income tax is the main source of revenue for the Treasury. So it does beg the question, where are the Treasury expecting to get this extra revenue from to erode this deficit? I think, Osborne's got a very difficult task ahead. But, good news for a lot of taxpayers there. Staying with the income tax side, a lot of people either don't know about this or can't be bothered claiming it, really. So the spouse can actually be quite a useful tax planning tool, if you like, in that if one of you is a non-taxpayer, the other's a basic rate taxpayer, the non-tax-paying spouse can actually transfer up to £1,100 of their personal allowance. So that can save you, okay, it's not a huge amount of money, but about £220 a year in a tax refund. And I understand it's fairly simple to apply online, takes 5 minutes on the HMRC system. So just another little tip there for some of you. A personal savings allowance. Now, this was announced in the last budget, but there was quite a bit of confusion about how it would be implemented, how it would work. Now, here's the detail. So a basic rate taxpayer will actually be able to earn up to £1,000 a year in savings income or interest in a tax year before they pay any tax on that interest. It's half the figure for a higher rate taxpayer, so a 40% taxpayer will have a limit of £500 before they start paying tax on interest. Unfortunately, for people earning over 150k a year, there's no benefit there at all. So, how does it work? Well, this is how you claim it. In fact, you don't need to do anything. Now, the banks are supposed to start paying interest gross to personal account holders. And the idea is that the banks and building societies will actually start providing information to HMRC so that they can get your tax code correct, basically, for the tax year. If you fill in self-assessment, then you don't need to do anything. You'll just continue with the self-assessment system as it is. Quick look at pensions. There was a big hoo-ha before the budget, and the Daily Mail got very excited, saying tax-free lump sums might disappear, higher rate tax relief on contributions may disappear. Osborne made a big U-turn here. I think a lot of it was down to Tory backbencher opposition to this in the run-up to the Brexit votes in June. So, you know, some welcome relief there for taxpayers, people who pay into pensions. So, good news, no changes to the income tax relief on pensions for now, but I've no doubt it will come under attack in future budgets, whether with this government or a future government. Salary sacrifice, there was mention about salary sacrifice in the last, in the July emergency budget. So, what Osborne has said here is pension salary sacrifice is safe, but other areas, more contentious salary sacrifice arrangements may come under attack in future. The tax-free lump sum is still around, so you can still take 25% of your pension fund tax-free when you draw benefits, so that's good news. Other things we already knew, so for high earners earning over 150k a year, the annual allowance, or the amount that you can pay into a pension per tax year, is going to start tapering away, and I'll tell you a bit more about that in a second. The lifetime allowance, the amount you can actually save into a pension, is currently 1.25 million before you start getting hit with some quite severe tax penalties. Now, that's going to drop from April the 6th to £1 million. And you might think, yeah, great, £1 million in a pension is a lot. But believe me, over time, it's affecting a lot of people, particularly people. We've got bankers in the room, so people with decent defined benefit, final salary schemes. Okay, they're a bit of a thing of the past, but people who've worked in a big blue chip company may well have a decent final salary scheme. And you would be surprised how easy it is to actually breach that £1 million threshold. Possible future changes, there could be some changes to the rate of relief on contributions. There's no change this year, but I've no doubt in future that there may be a flat rate of tax relief, maybe 25 or 30%. And again, there may be further reductions in the lifetime allowance. So there's Mr. Cowell looking rather pleased with himself. This is probably bad news for him, being a high earner. So for anyone earning above £150,000 a year, you're going to start seeing the amount that you can pay into a pension per tax year start eroding. So similar to the income tax, the personal allowance I mentioned earlier, so for every £2 of earnings above 150k, there'll be a £1 reduction in the annual allowance, until eventually you can see someone earning 210,000 or above, their limit has dropped right down to £10,000 per year. So I think high earners are going to be looking for more creative opportunities for income tax planning. So that brings us nicely on to something called the Enterprise Investment Scheme. Now, this has been around for, crikey, I think 22 years now, since 93, 94. And it's a superb way for some people to get income tax relief, because similar to a pension, you pay an initial sum of money into these schemes, and you get an immediate income tax saving in the tax year you make the payments. And the rate of tax relief is a flat rate of 30%. So you can actually pay up to £1 million per tax year into this type of scheme. Not many people have that sort of cash knocking around, so I've put a more realistic example together here for somebody putting £50,000 into one of these schemes. So they would be able to offset £15,000 against their income tax liability during that tax year. So the actual cost of the investment is only £35,000. These are investments, they're not without risks. They tend to be in smaller or start-up companies, but they're a good way to support smaller businesses, and this is the reason they were set up 20-odd years ago, to help raise finance for smaller businesses. So not right for everybody, they can be quite risky, but again, it's another strategy that we can talk about with clients if they want to save on income tax. Moving on to capital gains tax. Now, I think a few years back we did a bit on capital gains tax planning. The good news is the rates of capital gains tax are coming down, as Tim mentioned in his discussion. But some quite simple things to think about are, firstly, what they call bed and ISA, so selling your investment and reinvesting it within an ISA, which of course is tax-free. Bed and spousing, it sounds a bit naughty, but it's not really. It's effectively, again, selling the investment and transferring the ownership to your spouse. Again, making use of your spouse as a good tax planning vehicle. Third point, transferring assets to a spouse or civil partner. Now, this is quite good for a family business because you can actually transfer assets between spouse without any gain, any taxable gain. So I think, Tim, you did mention a bit about the dividend income tax allowance of £5,000. So one thing business owners might want to do is transfer some shares to a spouse to take advantage of that dividend tax rate of 0 on the first 5k of dividends. You can actually realise losses in the same year as a gain. So if you've got investments or assets which are at a loss, and you've got other investments that have made a gain in the same year, you can offset the loss against the profit on the other assets. And you can actually carry forward that loss indefinitely to use it in a future tax year. So that's capital gains tax. I wasn't sure whether to even include anything on the inheritance tax. It was a bit of a damp squib, to be honest. There were some changes last year, which Mike Donnan went through in some detail, especially around the new nil rate band, main residence nil rate band, which is going to be phased in from April 17. I think we established really it's not going to help a great deal of people in society. It might help people with very expensive properties in the south and not much in the way of other assets or savings. But again, the devil's in the detail with this nil rate band. But if you need advice, do ask us. But you've still got the typical exemptions, the annual exemption of £3,000. Any gifts you make after 7 years are exempt from inheritance tax as well. That's not changed. But the bad news is the nil rate band is frozen until April 2021. So not a great deal of good news there, unfortunately. Yeah, and I really started to feel my age this week. I'm too old for the old 1830 holidays now. And the government, in their wisdom, have brought something out called the Lifetime ISA, which I just about qualify for. So this is coming in April 17. So you have to be between 18 and 40 years of age to qualify. And I think what the government are trying to do is help the younger generation save. And I think you may have heard in the run-up to the budget talk of pension ISAs, so making pension just like an ISA, a bit more flexible. But this is good news for young people because they can pay up to £4,000 a year into this lifetime ISA, and the government will give a 25% top-up. So, unfortunately, if you're over 40, it's of no use to you. I do think this is the Chancellor's way of slowly trying to increase the age at which you can draw pensions. Because if you notice with this, the 18 to 40 ISA, the minimum age that you can draw it for retirement purposes is going to be 60. Presently, for private pensions, SIPs, etc., you can start drawing those at the age of 55. So it's raised a few alarm bells for me in that I think in future years that's going to stop. The age at which you can start drawing the pension is going to be moving up to 60. Okay. And we've seen already that the state pension is moving up to 68 for many people. But yeah, some good news for young people. And I think overall, a fairly positive budget, if not slightly controversial, unfortunately. I think Osborne's going to be up against it today in Parliament, have some tough questions to answer. But that pretty much rounds things off from me. Back over to you, Andrew.